Ladies and gentlemen, fellow finance warriors and hardworking ordinary folks trying to stay afloat in this turbulent economy, while we're still spinning around in this mud pool of recession, as if it's some endless circus orchestrated from up above. Yet again, we are facing more perplexing data from the economic front. So what are we looking at today? Oh well, nothing shocking. The twists and turns of U.S. employment data have got us, yet again, scratching our heads or maybe bang our heads against the wall. More jobs, less jobs, wages cooling, some job markets overheating, all in a beautifully confusing, we don't know what's next scenario. Let me break it down point by point from this latest report by ADP. Yep, the one with payrolls and employment trends. And then we'll zoom out to look at the broader economic issues that the nation is facing. Buckle up, guys. Things are only getting messier. Let's start with the one piece of positive news. Private payrolls added 143,000 jobs in September. Sounds sweet enough. Huh? After a run of 5 straight months of dismal hiring, we finally got an uptick. But get this, the 3-month average comes out to just 119,000 jobs, one of the weakest numbers since 2020. Even in a so-called recovery, that's well below what any sane person would call a healthy job market. So what's actually happening here? It's almost like the Fed and big corporate players are trying to sell us the idea that this sprinkling of new jobs is proof that everything's stable. Don't be fooled, folks. Hiring, in this case, is essentially stagnating. Sure, it's not free-falling just yet, but it's plodding along in a cooling economy, just as the Fed ordered. Look, let's be real, wages have remained stagnant for the past decade for millions of American workers, and now, after an inflationary boom, they finally begin to rise. Right? Wrong. Wage growth is, quite literally, cooling faster than expected. Let's take a closer look. Wage gains for job changers have decelerated to 6.6%, while those staying in their current jobs have seen their income crawl up by just 4.7%. And what's ADP's economists have to say about this? Stronger hiring didn't require stronger pay growth. Sure, Nayla Richardson, keep telling us that. The reality on the ground is just the opposite. Employers are reluctant to increase pay in a slowing job market. They know workers have fewer options, and the illusion of leverage that job hoppers once had is quickly evaporating. So, to those of you holding out hope for your next raise because inflation rates are easing, I'd say don't hold your breath. The sad truth is, wages aren't keeping pace with inflation again. But let's move on, we've got more problems to discuss. Here's another kicker. The bulk of the job gains are coming from the leisure and hospitality sectors. The low-wage, high-turnover gig jobs. Don't overflow with joy just because your local barista found work at the nearest chain cafe. Most of these jobs pay a pittance and offer no benefits. Sure, we've seen job growth in construction, but how sustainable is that? When interest rates are painfully high and real estate is cooling down, this may just be another short-term blip. Meanwhile, sectors like technology and information, well, we're looking at job cuts and freezes. The information sector reported zero growth, and even smaller firms, those with under 20 employees, are slashing numbers. The signals are clear, we're not talking serious job growth here. They're simply pegging the minimum levels for survival. More layoffs. That's right. Some of the biggest employers aren't waiting for opportunity to swing back their way. Companies like CVS Health Corp and Samsung Electronics are shipping people off with pink slips. Sure, right now layoffs are still relatively low, but let's not fool ourselves. These are the first dominoes to fall. For governments and corporates, strategic job cuts are the most convenient way to offset expenses as they tighten the belt. And isn't it laughable that we're seeing some corporate layoffs in the middle of a so-called recovery? Again, how many times have we heard this from officials? We're seeing stable numbers. Conditions are improving. We're on the path to 2% inflation control. Rhetoric aimed at keeping people passive and compliant, while real wage stagnation and job loss continue to happen behind the curtain. The official unemployment rate remains stagnantly at 4.2%, held like an anchor from causing public panic. But wait, didn't Fed Chair Jerome Powell just tell us labor conditions were cooling? And what exactly is meant by that fancy jargon? Well, simply put, corporations are flexing their muscles, slowing down their hiring, giving pays only where they absolutely need to, and scaling back expectations as demand softens in some sectors. And let's also talk about real unemployment. We keep hearing the 4.2% figure, but how accurate is that? What about the underemployed? The people reduced to part-timers, freelancers, and gig workers desperately holding on to whatever scraps they can find from platforms like DoorDash or Uber. It's another misleading figure painting a picture of stability in a time when there's anything but. The dance we're watching here is all part of the Fed's strategic cooling to bring inflation down to 2%. But here's the harsher reality. The Federal Reserve's policy moves will disproportionately hurt the marginalized. Working-class constituents are paying the price for this supposed move to stability as unemployment sneaks up from underneath. Even though officials love telling us it's all under control, capital continues flowing, corporations still hoard capital, and if you ask them, well, they're happy to comply with tightening. The September rate cuts intended to curb a wider crisis? Merely a charade. The short-term relief for credit markets momentarily stopped the bleeding. But sustained instability in earnings and jobs paints a very different future. And as is typical in these economic downturns, the working class, the same ones celebrated in speeches, will bear the brunt of economic corrections. Ladies and gentlemen, the problem isn't isolated to wages and jobs alone. We must recognize that a lot of sectors, particularly manufacturing, tech, and finance, are facing hidden contractions as companies brace for further recessionary shocks. With rising geopolitical risks, supply chain realignments, and the aftershocks of high inflation, corporate layoffs are going to become more pronounced. And, while companies tout streamlining management or optimizing costs as their main reasons for trimming their workforce, the real driver is the weak demand trickling down across the entire global economy. What we're watching in terms of job growth isn't sustainable. It's fragile, limited, and could easily shift back into negative territory if macroeconomic conditions worsen, which they likely will if the credit markets tighten further. So there you have it. The labor report gives us a small sweetener with 143,000 job gains, but don't pull out the champagne just yet. It's not going to last long. Ask yourselves this. We've been cooling down labor markets to stop inflation, but are we really the ones overheating? Or is this the corporate elite attempting to hedge their risks at the rest of our expense? Time to think deeper and start asking the real questions about where this is all going. If this employment slowdown continues, we're headed for more serious disruption. Smash that like button, give us your thoughts in the comments below, keep yourself informed, and if you think things are only going to get worse, well, you're probably right. Stay sharp, folks. The game of economics is just heating up.